So that's where I am, and I'd much prefer to be diversified over, normal, old-fashioned, boring, diversified portfolio of cheap companies. But I'm not. I hate bonds. I absolutely hate bonds. The Fed has filled the breach several times in the last 10, 15 years. If America's to keep being the number one superpower, they've decided that they've got to be able to build battleships, which they can't really.
Okay, guys, so today we have Clem Chambers, and today we're going to discuss the state of the current economy with the recent economic data. We'll talk about commodities, the crypto sector, and we will talk about portfolio structure in the current environment. So Clem, thank you so much for being here.
Great to be on. Thank you.
Thank you very much, Clem. So I would like to begin by talking about the overall US economy. So recently got economic numbers. We got the employment revisions as well. So what's your take on what's happening right now, Clem?
Well, the trouble is you could look at the past and you can, say, oh, this number, that number. But the future is extremely unpredictable because this new administration, it's not totally new now, but I think now everybody realizes it's borderline a revolutionary administration. So the outcome of their behavior is really very hard to predict. And it's very easy to say it's going to be bad. It's more difficult to say it's going to be good. But you can't really just take it as read that it's going to have a negative effect. And, it's basically a big change underway. And the big change is to try to reindustrialize the US. And the reason for that is for the idea of American exceptionalism, which Americans enjoy, is kind of running out of road because China has been on the ascendance for so long now that it actually maybe they're the exceptional one now. They haven't caught up yet on GDP, but they're going to. And they're going to catch up in GDP per head as well, if you take the trajectory of the last few years. And the American government is trying to change its trajectory, which is one where the growth is like that, mild, and the Chinese growth is more. Now, there's lots of problems with the Chinese economy and lots of problems with the American economy, and lots of tension between the two now for very, very many reasons. I mean, if you look back maybe 10 years, you had much more collaborative leaderships in both places. And Xi is basically much more of a, we're the greatest. And of course, America's always maintained that position. And therefore, you're getting a clash occurring. So this change of bringing back industrialization to America, well, that could be very good. It could be not so good. The old joke was nobody wants to be working in a sweatshop in America anymore. That wouldn't be a good thing that we have the sort of industry that China has. But I think in many ways, that's quite an outdated view. China is now doing some, bleeding edge things. They're making, steel for fission reactors that can't be made in the West. They're making robots that seem to be potentially advanced on what even Tesla's putting out. Their car companies are making the most amazing cars at a price that really can't be matched. And on and on and on. I mean, if you go to China and you look at what they do, you can go, oh, wow, look at that. Anybody coming into JFK, or for that matter, flying into the airport in Dubai, will notice that perhaps America, and for that matter, Heathrow, the UK, and for that matter, Charles de Gaulle in France, are actually in the second division now. So America is planning to try to change all that. And of course, that changes everything because up to now, the idea has been America has been doing its thing. And who needs the primary and secondary and even tertiary industries when you've got the Googles of this world, you've got the Metas, you've got the Amazons, you've got the Nvidias, Nvidia being the best example actually right now. So we'll stick to that. And, China can stick to making stuff. That's all well and good. But if you are going to be the policeman of the world, where all your raw materials are getting made by someone else who may actually not be a policeman or even playing nice. Things have to change. So if America's to keep being the number one superpower, they've decided that they've got to be able to build battleships, which they can't really. They've got to be able to make steel and aluminium, which was, going away. I mean, how do you actually be able to, rather you don't want to, but you've got to be able to fight a world war, haven't you? And if you can't make ships and you can't make tanks and you can't make much steel and you can't make much aluminium, and you are really all you can do is make Google ads and make people send messages to each other and maybe make a few AI chips. You're out of the picture, aren't you? So you have to rebuild the ability to actually make stuff, physical stuff. I mean, many years ago, I don't think it's changed much, but America couldn't make a light bulb. I mean, it simply did not have any light bulb factories anymore. Now, I don't know whether that's changed or not, but it's a good example of the problems that America has been facing and that this new administration is planning to fix. And to do that, you have to build from the bottom up. So you'll see the Pentagon has bought into Mountain Pass, for example, which is a rare earth mine on the borders of Canada and Nevada. And that mine's been there for decades and decades. And although everyone's been saying China's got the stranglehold in rare earth, it's been languishing there because China pops up and says, oh, no, we do all the rare earth. Oh, we're going to compete with you. Well, we're going to undercut you. You're not going to be able to make rare earth as cheap as us, and then no one's going to buy yours, are they? And therefore, you're going to go bust. And therefore, we keep our stranglehold. Every time you try to get into rare earth, we're going to undercut you, and you're not going to get off the ground, are you? So, and that's their strategy, has been their strategy, and that means they have a stranglehold on basically a large proportion of the critical minerals that the West needs to be a industrial power or a power at all, really. And they've got that stranglehold. So America's gone in and written a big check to Mountain Pass and guaranteed them an offtake price, which means they can't be undercut, and is investing in that supply chain because you can't have a argument with another country if they've got your supply chain by the throat. And that's the sort of thing that we are now seeing. And that's the sort of thing that changes the investment picture quite dramatically. Well, it's the 800-pound gorilla changing its strategy. And that strategy is what affects prices and what affects all those kind of things. I mean, the thing that will go down like a lead balloon with your crypto people is 25% of all the mining of Bitcoin comes out of Iran. Okay? So imagine that American government said, right, we don't like Bitcoin because Iran makes 25% of it and we don't like Iran. Boom, gonna ban that. Well, that would be, pretty, you'd see Bitcoin fall pretty hard. But my point is not that it's going to happen. My point is that when things operate at the top level, like the government of America, it changes the game absolutely dramatically. And that game has been changed quite dramatically. And that's going to have a big effect on prices. And I don't think many people have been able to work out all the permutations, been able to price in all the implications of all these things. So really, the ground is open for anybody who's prepared to really work hard at trying to work out what's going to happen in the next 3 years to make very, very good returns.
Thanks for that, Clem. And so we have a lot going on with the Fed right now. So what's your take on all this mess that's happening? So Trump wants to remove Powell. He wants lower rates. Powell's trying to stand against that. And it looks like it's going to happen in September. And Powell will be eventually gone. But what's your take on the whole situation, Clem?
Well, I'm one of the few people that highly rate the Fed, I think, out there in the blog sphere. I think they've done an amazing job. And it's not their fault that they've got a runaway government printing money and spending it like water. It's not their fault that COVID happened and they had to bail out not only America, but half of the world at the same time. It's not their fault that inflation occurred because that inflation was a result of having to bail out the world when it took a holiday for a year or however long it was, whatever drop in GDP was caused by COVID. And when you get those disjunctions in the world, it's always followed by high inflation. Just look at history. I mean, just look at what happened to the French franc from before the Second World War and after it, and for like 15 years after the Second World War ended. Their currency just went to pieces because of the impact, economic impact of that conflict. Well, the economic impact of COVID was giant, absolutely giant. And the way you pave over those, paper over, I should say, maybe pave over is quite a good way of putting it. The way that you paper over the sort of hole that is created by that sort of event is by printing money and paying for it with inflation later. I mean, inflation is just a tax. So, you know, the bailout of 2008, 2009, that the Fed did, which was, necessary, the whole American government kind of caught up with bailing stuff out or acting before the disaster rather than cleaning up after it. And you've seen a lot of that since. And COVID was one of those things. And there's been a few. The banking crisis of a couple of years ago was another one. And they've managed to do that. But there are costs. You can't bail out these things without there being costs. And people seem to think, oh, the bank's got a bailout. Oh, the rich people got a bailout. What about me? Well, everybody gets a bailout when there's a bailout, because it doesn't matter who gets bailed out. If they didn't get bailed out, the ramifications, the dominoes that then fall, go right the way back to everybody's front door, as they found out in 1929, stock market crash. Roosevelt and his rather interesting ways of dealing with it caused more trouble probably. But that Great Depression was caused because Wall Street wasn't bailed out in 29. And, everybody had to eat crow for a best part of a decade. And, the Fed has filled the breach several times in the last 10, 15 years. And of course, what people don't spot is disasters that don't happen. It's almost an accident and you don't have it because the regulators are doing their job or whatever. And people go, oh, and what? If it happened, they would have got and what for sure. But, it's like that near miss on the motorway when somebody swerves in front of you, you swerve out of the way and you don't crash. 1 centimeter more, it would have been a whole different reality. You would have been on the hard shoulder, your car written off, waiting for the tow truck to come. But instead, it didn't happen. You went, oh, and you forgot about it in 10 minutes, and the same goes for economics. If you don't get a crash, what could have happened when Silicon Valley Bank got into trouble and all those guys around that time, if that had been a repeat of, many bank runs in the past that had not got caught early, it would have been something that would have caused mayhem for quite some time. So I have a high opinion of the Fed. Now, they don't want to drop interest rates, and they've got all the tools. I mean, they've got serious amounts of econometrics, and they're probably pretty good they probably, let's just put it this way. I believe they know what they're doing. Okay. Now, when you look at the long-term bonds and the fact that those interest rates are elevated and they want to go higher, and basically the government has to keep stepping in to keep the long bonds yield from going up and therefore the value of bonds going down. Well, that suggests that interest rates do want to go up, are at the right level. Because if you bring them down at the Fed level, everything's got to come down with them. It's no good you dropping your interest rates and interest rates in the economy stay up, or perhaps go even higher, because everyone's now worried that the country is going to go on a run and print more money and there to be inflation. So, I think the good old fashioned trust the Fed, let them get on with it. It's a good one, but I don't think that's the current administration's way of doing things. I mean, I was reading some news, and it's hard to believe any news these days. So you have to take everything with not only a pinch of salt, but a cup of salt, that Trump is going to let Powell be sued for the costs of building this new building, blah, 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 and all that stuff. I don't know whether, I'm sure it's just a mess. I think the Fed will be lowering interest rates and Powell will be going on his way later on or early next year. And somebody who knew will come in. And if Trump picks Mr. Inflation as the next Fed governor, then we will get low interest rates and even more elevated inflation. And you know, for me, the hard choice is when you look at that administration, are they, brilliant or are they mad or both? And, the impact on asset prices is really, really huge because it all comes down from the top in the US. But the reason the stock market is so high, that's purely because of the government. And it's not even borderline manipulated. It's a policy. Everybody pump money into real estate, pump money into equities. Anybody can get on that train. It's a good train because it creates wealth. As long as people think it's good, it creates wealth. And as long as that wealth is believed to be good, it creates more wealth. It's a virtuous circle. But it can be a vicious one too. So, there's a lot of, well, everybody knows. Does anybody not think we're not in for a lumpy, bumpy rock and roll time? And I think that's what we're in for. And for traders, that's great. That's time they get their boots on and make the money. For investors, depending on your tack, it's a way to make money as well because it certain things will move more. The velocity of the market will increase, and as risk equals reward, the rewards will increase along with the risks. So if you're switched on, it's good. Technically, theoretically, if you just ignore everything, stick it all in the S&P 500, forget about it. It's all going to be work out fine for you, and it's a good argument. I look back and I say, yeah, that's right. I look back and I see it's right. I look forward and I go, oh, I'm not so sure that's right.
Yeah, so you made some very good points, Clem. And talking about the stock market, so with all the risks that you have mentioned, and yes, historically S&P has been doing well, but it also had these decades where it just stayed flat. So what's your take, Clem, on the S&P? Would you be getting involved at the current levels, or would you be expecting normalization of valuations in a slow way or a rapid way? What's your take on the current stock market?
I think it's most important to know what kind of investor or trader you are. First of all, you've got to know whether you're an investor or you're a trader, a speculator, gambler. Okay. Now, traders normally have a hard time in any market because there's only a third of them, if you're lucky, can actually win at that game. It's a highly skilled game, and if you're highly skilled, then you do well. If you're not highly skilled, you'll have an expensive education. So that's traders. That's the speculators, and if you want to be, use the other word for them, they're the gamblers. Stock market gamblers. That's a completely different game altogether. Now, for the investors, it depends what kind of investor you are. If you're one that just wants to put some money in the stock market and you've got your 401k, you're going to bung some in gold, you're going to throw some into bonds, you're going to put some in the market, and you do not want to look at it every day. You don't even want to look at it every week. You probably look at it every 3 months. Then you want an ETF. Then you want to, get the Spider or whatever ETF you want. If you want the QQQ, go to QQQ. Get the Nasdaq, get the S&P 500, get the Dow. Whatever you fancy, and then you just pour money into your 401k or your portfolio and just keep pushing it. Dollar cost average, job done. And that has proven, if you look back, that has proven to be a fantastic way of doing it since about 1982. So famous last words, it all changes tomorrow. So that's the best part of 50 years. Yeah. The past doesn't predict the future and all that. But yes, and they've been saying that for 10 years as well. So that would be what I would do if I was somebody that, had a boat, liked to go sailing, has a garden, likes to, dig potatoes, hasn't got the time or energy or interest in investing. And that's most people. So for them, ETFs is the way to go. Yeah. For the people that want to do a bit of study, then you're in stock picking land. And then in stock picking land, it depends whether you want income, depends whether you're a contrarian, whether you like value, or you want to go momentum. And the way to handle that is to basically look at what sort of shares you like, and then say, well, what Am I a value investor? Am I contrarian? Do I like small caps? I do what kind of guy am I? And then once you've decided what theme you like, then just follow that theme and study up on it and follow the information and away you go. And then it becomes one of your pastimes. And if one of your pastimes is investing as opposed to trading, which is very different, you'll do extremely well. You do extremely well.
That's a very good advice, Clem. And just to touch on the bond market, in the current environment with the money print and everything, what's your take on owning bonds right now?
I hate bonds. I hate bonds. I absolutely hate bonds. I mean, I've always hated bonds, and I think I always will hate bonds. I mean, I'm the sort of person that reads a book. I mean, I think it was Samuel Pepys' diary, the first diary ever written from 16, boom. And there he is, lending money to the king, I getting a bond, and never got his money back. And there am I looking at all this. I think it's called scriptophilia, which is old bonds and old stock certificates from way back. And every time I see a bond, railway bond, did they get their money back? Venezuelan bond, you know, ah, a Weimar bond. I just go, oh no, no, never get your money back. But of course, the American bonds, they've never defaulted, apart from the fact they have really. But because inflation is a kind of default, and there's been all other sorts of events where they've said, yeah, this bond, I think it's the war bonds they defaulted on. Yeah, these bonds, no, no, we're not going to pay them back like we said we were going to pay them back differently, which is a default. Um, but I look at them and I go, oh, I'm going to get 5% on that, and inflation is 6.5. Oh, I'm going to get 5 on that, and inflation's 3. But when I look at it, it's about 8. It's yeah. I mean, classically, you have some bonds, you have some equities, you have some gold. You futz about with a small proportion of crazy stuff, and that's what works for you. And a diversified portfolio of risk is absolutely the way to go. Even if you're totally skilled, a diversified portfolio of risk, which at the moment I don't really have. I mean, people would say I do, but I'm not happy because I can't. It seems to be a very specific market. So I've got a lot of precious metal, got a lot of defense stocks, and I've got a lot of deep value or contrarian value. It's that deep, the value. And that doesn't fill me with happiness because that is not, as far as I'm concerned, diversified enough. And my old portfolio, which I sold just before the market crashed, and I wrote a few articles about, oh my goodness, we're going to crash, I'm out. Oh no, it's going to crash, oh it's crashing. And I was not expecting it to do that crazy return that we saw, which comes out of the Treasury, I suspect, which is it's another bailout, and no one's even admitted to it this time round. And nobody predicted that. Nobody could have seen that coming. I certainly couldn't. And there's never been a recovery like that ever. Show me one like that ever. Straight back, a V-shaped bottom. Well, a V-shaped bottom on a crash, that is intervention. But the portfolio I had, which was diversified across, widely diversified, did so much better than my undiversified portfolio, which I got back in when it started to bounce. So again, once again, every time I look at it, diversified portfolio risk is the way to go. And there's been a pullback in the market, and that means for a week or 10 days of sadness for a shareholder like me. But up goes some of my crypto, and it's just a perfect example. I mean, the only crypto that I haven't disposed of since Bitcoin hit 100,000 is Ethereum. And it's just gone from nuppence to 4-4. I mean, who knows where it's going to go next? But that's the sort of thing that a diversified portfolio gives you, because you can't work out the timing. Timing is very difficult, but value, that's much easier. But as you can't predict time, and you have all these different good value instruments, and they're all juggling around, and some that are great are cheaper, getting cheaper, and some that are not so great somehow are getting more expensive, and that gives you the coverage and enables you to have a good turnout in your investments, rather than get one wrong and only have 3 and lose a third of your portfolio in one small mistake or one large mistake. So, we all make mistakes in investing. And if you spread your decisions wide enough, they all evens out. And that is, I mean, it's funny because Buffett and Munger have said, "Oh no, you need a concentrated portfolio." Well, that's not what they've got at all. They've got a massively diversified portfolio. If you look at their portfolio, you go, "You've got like 40 stocks in here. What are you talking about being concentrated? That's not concentrated at all." So, it's diversified portfolio risk, dollar cost averaging. They're two of the magic beans in investing.
So, Clem, you mentioned that you sold your Bitcoin and you like gold. So, I would just like to see how you're thinking about structured portfolio in the current environment with all the choices that we have.
There's no reason not to have 2.5% of your portfolio in crypto. No reason at all not to. Yeah. Now, it might all go to zero, but that's why I use 2.5%. And there's no reason not to have the same or more, 3 or 4% in gold. And that ain't going to zero. And that could go to the moon. Who knows? And the crazy stock that you've got in your portfolio could make up for all of those. So that's why you have a diversified portfolio risk. But you've got to spread so that you're looking at it and you go, I can sleep at night. I don't mind if Bitcoin goes to 30,000 now. I've got my, 2.5% in Bitcoin. There it is. And if it goes to a million, billion, trillion, I'll be telling everybody how clever I am. If it goes to zero, I won't care. And pretty much with most investments, that's how you should take it. If it ever wakes you up at night, you got too much of it. Yeah. And in the long run, it will do you no good to have those sort of things in your portfolio. If you've got all your money in Nvidia and you can sleep at night, that's great, that's fine. But the moment you're worried about it going down is the moment you shouldn't have it, because what's the point of being miserable your whole life and then being a rich old miserable miser? And there's it's not good. It's not good. So one of the beauties of a diversified portfolio is that you can sleep at night and you're not waking up at 3 a.m. in the morning to watch the Japanese market open. And a lot of people do, particularly traders, people that are overcommitted, they are watching that pixel at the end of the graph pretty much the whole day. And that way madness lies. Or, I mean, I used to trade a lot when I was young and I just burnt my stomach lining off. So, it's like, I can't be bothered anymore. Yeah, I'm making good money, but yeah, I can make just as much investing. So I'm going to sleep at night. And there's an old joke about, I bought this, I'm going to rephrase it for crypto. Why not? Someone said, buy Bitcoin and you'll sleep like a baby. He was right. I wake up every 3 hours crying. Yeah. So, you don't want to wake up every 3 hours. You really do want to sleep.
That's a very good point, Clem. And so, Clem, with everything we talked about, would commodities be part of your diversified portfolio? Because if we look at everything that's going on, we mentioned the globalization that's happening and everything. I mean, fundamentally, a lot of these commodities look really, really good.
Look, I don't like commodities. I never have liked commodities. I was brought up by a commodity trader. And I saw the ups and downs and the swings and arrows of that thing. And I, as an investor, wanted nothing to do with it. But right now, I've got a lot. Because as you say, it's to me, and I could be horribly wrong, it wouldn't be the first time, we're in a new world where the periodic table is in fashion. Yeah, because if you are going to rebuild America, you've got to build it from the ground up. You can't have all this stuff being shipped along long supply chains. You have to you have to shorten those supply chains. You have to make them defendable, and you have to make them, right here, right now. And of course, you can, but you have to get prices have to be higher. And when prices go up, prices go up. And there's also lots of elements. There's not enough of it. For me, the big thing that everybody should think about is AI. Now, people have heard a lot about AI, no doubt, but I have a different take on it. There is no second place in AI. Yeah. If I'm smarter than you, I will beat you. I will eat your lunch. You are toast. And that goes for individuals and it also goes for countries. So America can't be second place in AI, and you'll see lots of this going on right now in the news. And you go, what did they do that for? Why is he chewing out the boss of Intel? Why does he love him all of a sudden? What's going on there? Why would why has the American government decided that they're going to tax exported Nvidia chips? Yeah, that's a first. I need to actually sit and cogitate on that one. Basically they've gone to Nvidia and said, yeah, you can't export that. Oh, all right then. You can export it, but you've got to give us 15% of your sales. I mean, sounds like Don Corleone talk to me, but nonetheless, AI, right? Oh, what's all this about rare earths? Oh, it's kind of all to do with that high tech stuff and AI and why are they talking about all these nuclear power stations all of a sudden? AI. Because AI, there's no second place. Okay. Now, the second step is AI is almost pure energy consumption. And they are building these service centers like you've never seen before. They are going to build them everywhere and they're going to build energy everywhere. They are going to boil the oceans. And to boil the oceans, you have to build massive amounts of energy generation. And then you're going to rebuild factories and they're going to need raw materials. I mean, I've platinum and palladium, I've got a lot of, and I've spoken about that quite a lot. That's a remediator of environmental problems, okay? And it's a catalyst. If you've None of this energy stuff is going to go away. They are not going to retire coal now. They're not going to retire nuclear power now. They're not going to retire the internal combustion engine now. None of that's going away because there can't be too much energy because there can't be too much AI. Yeah. What are they going to do for copper? There was a problem for copper, with all the windmills that they were building. There was not enough copper to go around. They need some. You have to go look it up. It's something like they have to make 50 million miles of copper cabling for all the energy that was going to be done before the AI thing cropped up. It's all and copper. Yes, you can use other things, but not really for copper. For some things, so there's copper cut is just going to go up a lot. So you either get yourself an ETF, a copper ETF, which I haven't done, or you buy somewhere like Freeport McMoran, which I have, which is the American copper mine. Yeah, but it's almost incredible to me that it hasn't already gone on a run. But actually, no, because quite often I buy shares and they sit around for 2 years and then they explode. And I go, why did it take them 2 years to work this one out? It's pretty obvious. Yeah. So, there are big issues with commodities and lack of supply coming up. And so, yes, even though I really don't like commodities, I don't like miners because their numbers never make sense to me. I have to trade what I see. I have to invest in what's obvious. And it's obvious that copper's going to be in shortage in the next few years and platinum and palladium are going to be in shortage. When I started to talk about platinum and palladium only a few weeks ago, practically, I started talking about it. Blooming thing's gone up 30%. Just went straight up. It's almost as if someone listened to me and went, I better buy some. And they only make 200 tons of platinum a year. 200 tons. 3,200 tons of gold, 200 tons of platinum, 200 tons of palladium. 200 tons like none. Yeah. Anyway, so platinum, palladium, gold, silver, copper. I can't not hold chunks of that. Quite a lot of chunks of that, and I don't want to. I want to hold shares that make things because I'm much more comfortable with that, and I like my dividends, and I like cheap companies with low PEs. I'm old-fashioned value investor. I'm sort of like the great 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 grandson of Warren Buffett. I like doing what he does, but now in this new environment, I mean, you've got to be thinking about defense stocks. You've got to be thinking about strategic minerals, and you've got to be thinking about that all really deep value as well is always a good thing. So that's where I am, and I'd much prefer to be diversified over normal old-fashioned boring diversified portfolio of cheap companies, but I'm not.
No, I fully agree with that. And if we look at the mining business, you cannot just switch the switch and get more commodities. It's a very long, tedious process with all the permits. And yes, if AI goes where
That stuff will all be going away, I think. You see, I think you'll see a lot of the old givens not givens anymore. Yeah, and I think you can already see it in the news. Whereas once every article wouldn't matter what it was about, the bottom paragraph would say, all this X is caused by climate change, and I think you're already seeing the climate change story falling away. Yeah, because you can't have AI without having vast amounts of energy production. And who wants to be a vassal of China or of America? Because you haven't got enough AI. You haven't got enough. Oh, can I please, sir? Can I have some of your AI? No, you can't. No, no, no. You're under our thumb. We're smarter than you. So, you can't get this AI without generating vast amounts of energy. And that in itself is going to produce an economic boom. Yeah. Not, you don't have to think about what AI is going to do in terms of productivity, and that will be huge. Yeah. The generation of vast amounts of energy will mean that energy will be available all over the place and people will be encouraged to use it for load balancing. And that will be tremendous for economics. But of course, there's always politicians to mess it up.
That's a good point, Clem. So next question would be for the younger audience. So let's say we have an individual who's still at the beginning of their wealth building path. They have so many choices. They have the Bitcoins, the Nvidias, the things that we're discussing right now. What advice, Clem, would you have for that person of how they could, decide what to get involved with and to begin their wealth building path?
Well, the first thing is imagine that you're playing tennis. Okay. The last thing in the world you want to do is play tennis against a professional for money. Yeah. And all those black glass towers in Wall Street and around the world full of, banks, trading desks, you don't really want to be playing with them, do you? So you really want to start very, very simple. And you want to drip a little bit of money. You see, one of the things that you learn as you get older is that, hold on a minute, why is my overdraft always the same? It doesn't matter how well I do, doesn't matter if I'm unemployed, or doesn't matter if I've got a great job, doesn't matter if I get a bonus, doesn't matter if whatever happens, it always seems to be at the same level. And that's because we all navigate, or most of us navigate, to one's resources. So one spends up to one's resources. And that's for most people, that's always going to be the case. So how you deal with that is you just take a certain amount of money out of your account every month and put it into a special account, your brokerage account, for example. And you put as much as you feel comfortable to, and you build it up in there. Now, when it builds up in there, you look at it and you go, oh, I've got so many $1,000s there. Oh, that's rather good, isn't it? Oh, that's nice. You're not looking at it much. But when you look at your overdraft and it's, $999.90 and it's $1,000 overdraft, you say, oh, I better not go out for that dinner tonight and not until I get my paycheck. You're navigating your finances with that number, not with what you've got in your brokerage account. Maybe your wife's navigating for a new kitchen by looking at your brokerage account, but you're not. So it's building up nicely. So that's a mental trick to build up capital. Yeah. And then you build up your skill. So initially you take that money and every month or every 3 months, you dump it into an ETF. Yeah. And then you go, well, hold on a minute. I think I want 30 stocks. I'm going to buy one stock every 2 months and I'm going to buy $2,000 of it or $1,000 or 10,000. Depends how much money you've got coming in. And then every month you go and pick one out. And then you put it in and you track its return, you track its results. You invent a few rules to yourself, like if it makes 30%, I'm going to sell it, or if it goes up 10% in the first month, I'm going to buy another lot, or whatever those rules are that you've decided by reading a few sensible books. Read sensible books from Amazon, not how to make yourself a fortune trading, but if it's not about Warren Buffett, don't read it for the first 3 years, okay? Because it sounds like a trope. But that guy has become pretty much the richest man in the world by doing what he does. And it's all in books. It's all in books. Over and over again, the same old story in the same old book. And, people do not read that book. They just don't read it. And it's a very simple way of doing things. And you can listen to their yearly talks going back forever. And they say the same old thing over and over again. And you just look at their results, just look at their stock chart, and there it is. There it is. So that's where to start. Good old fashioned, basic, proper investing, and then build up your skill and dribble money in every month. And then within 5 years, you will be skilled up. You'll have a decent chunk of capital in there because you won't have frittered it away on upgrading yourself on that holiday, or buying a little bit better Tesla, or getting the latest Apple phone and the day it comes out, etc., etc., etc. So that is how to get off the ground. And the earlier you get off the ground, the better. If you can get off the ground in your 20s, it'll have a massive difference. If you can, it's fine in your 30s. It's fine at any time. There's no wrong time to start, because you will pretty soon be making better returns than you would from any other way of doing things. Investing is the only way a normal person can build wealth that I can see. You can get some lottery tickets of one for or another. Go be the receptionist at some startup that becomes the next Microsoft and all that. But they're just lottery tickets. Non-lottery tickets, investing in shares in a diligent, controlled, sensible, long-term method is the only way I know of a normal person building up enough wealth for themselves to call themselves comfortable.
That's a very good advice. Thanks for that, Clem. And just before we wrap up, Clem, what would be the best investing advice that you received when you were young and less experienced and had the biggest influence on your career?
Well, a long time ago, when I was about 10, I was with my father, who was doing exceptionally well in the commodity markets in the 70s, and he seemed to have way more money than all the other parents at this particular private school. Way, way, way more money. And I said to him, I said, Dad, how do you do this? How do you make all this money in the markets? And he said to me, he says, real simple, son. All you got to know is which way the market's going. And as a 9-year-old, I thought about that and I said, that's got to be complete rubbish. Can't be that easy, because everyone would do it. So anyway, about 30 years later, I remembered that little chat, and then I realized he was totally right. So most people, that's not what they're thinking at all. They're not thinking which way the market's going or which way the stock's going. They're thinking, this is going to go up and make me money. Or my mate told me this and I can make some money. They don't go, well, which way is the market going? Because at the end of the day, if you look at a share and you go, well, which way is this share going to go? Well, I don't know. My mate said it's going to go up. Well, you're going to have a hard time. If you look at it and you go, well, it's going to go up because of A, da 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 da, you're probably in great shape. Because if the market is going down or this share is going down, why would you buy it? So really, all you have to do is know that a share is going to go up over a certain time window. Okay, no, not think, not believe, not imagine. You got to know, and to know that there's actually another piece of advice. Where I was gold panning in Scotland. There we are. That's a fool's errand for a start. And I was up to me waist in freezing cold water, panning away. And this old timer said to me, he said, if you think it's gold, it isn't. If you know it's gold, it is. And you go, what's the difference between thinking and knowing? And then you get a little bit of mica that shines. Oh, I think this is gold. What do you reckon? He goes, oh, that's a bit of mica. And then you go panning away. 2 tons of rocks later, you got a tiny little fleck in your pan. You go, that's gold. And you know it's gold. And that's the feeling that you need to have when you're investing. So I know that's going up because, yeah, you don't think it's going up. You know it's going to go up. So as you go around, traipsing around all these different shares, and there's hundreds and hundreds of them, yeah, just keep looking until you go, oh, no, that's going up. Oh, look at that one. Oh, yes, I know, Spork Inc. is going to go up because my wife works there and says the CEO's a complete genius and he's, da 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 da. Oh, I bought their anti-gravity device off Amazon. It's amazing. I love it. It's brilliant. Those sort of insights. And that's when you invest. Or you go, well, I know if it's well, I mean, an interesting one was I wrote about it a few years ago. Exxon, it was paying like a 8% dividend. It was on a 6 PE, and this was 5 or 6 or 7 years ago. And it's like Exxon, it used to be the biggest company in the world. It's making vast sums. It's paying them out in huge dividends. It's got a PE so low it makes your teeth hurt. And I wrote a piece in Full saying you want to buy that. It went up 300% after that. Yeah. But it was like you look at it and go, how can this be not? How can this be wrong? In the same way as you could look at copper. And you can go onto the interwebs and you can search about global demand for copper over the next 10 years, and you can see that there's going to be a big shortage of it. So, you can then keep a track of that until the point you go, yeah, okay, I know that this is going to be a thing. And then you go looking for all the different companies and you look around and then you see one that, oh, I know that's the one. And then you make your investment. So, know which way the market for the thing is going. And then know the direction, and then really know that it's going to that you've got high conviction, and then you're safe to get it wrong, aren't you?
That's a very good one, Clem. So Clem, these are all the questions I had. Thank you very much for being here, and I hope to
Yeah,
have
it's
you
very
back.
good to be on Vlad. Very good to speak to you.